So we begin with the big issue, investors reacting to another round of tariffs.
This trade war is now getting a bit more serious.
It's not good for global growth.
The markets could get worse from here.
This will not be over.
It's a process, it's ongoing.
This is not going to be decided over 1 week.
It's quite hard to work out where you come out.
I would be happy just to know that they're going to continue talking, they're going to continue working.
It will create some ongoing business uncertainty.
Ultimately, they'll find some common ground to work on.
Net, we still think a deal will eventually get done of some kind.
I don't think we should be moving in from an exuberance to a panic mode, but it's probably time for pause and a reflection.
This next stage of the trade war gets a little bit more painful and a little bit more visible.
Joining me around the table to discuss, George Bory of Fargo Securities, Krishna Memani of OppenheimerFunds, and Kate Moore of BlackRock. Kate, let's begin with you. This market's actually taken it quite well, isn't it?
It has. And I think one of the reasons why it has taken it well is because people have been fading equity risk for this entire 2019 rally. You see this in the fund flows. You see this in institutional changes in positions. And it's been really interesting because people have been skeptical about the sustainability, even after a relatively decent earnings season relative to expectations. There has not been a lot of love for the equity market, and that's made options cheap in a lot of cases. It's kept vol low. And I think right now what we've seen is a little bit of consolidation this week, but no big capitulation because, frankly, a lot of people had already taken chips off the table.
Krishna, let's bring you into the conversation. I'm sure some people think I'm crazy for saying it's been taken quite well with futures down another 0.6%. Yes, it's the worst week of the year, but that tells you more about the year we've had than it tells you about this week.
Oh, absolutely. I think it's down 3%, but it has been up almost 25% from the lows. So the fact of the matter is the markets have done really well. But I think Kate's point is the most important one, which is the participation in this up trade really has been entirely missing. So people who missed out on this trade probably are going to look at it as an opportunity to buy rather than an opportunity to sell because they have nothing to sell. Having said that, I think the real driver of this is the kind of the modest downtrade is the fact that it is not a done deal. The fact that you don't reach a settlement today doesn't preclude it from being reached at some point. And then the third point in this regard is, well, let's say we actually have a trade war that is going to last for a reasonably long period of time. What are the other policymakers going to do in that context? The Fed is going to cut, and the Chinese policymakers will continue, actually increase their level of stimulus into the economy. You put all of that together, I think the markets are taking it the right way.
We've got a she put, a presidential put in the United States, a Chairman Powell put we can talk about a little bit later too, George. You've got to respect the risk in front of you.
Right.
Are we showing enough respect to that?
Well, I think you have to focus on the fixed income markets. Fixed income has held in reasonably well. I think the Fed has led rates lower, has given a very strong form of guidance in terms of their willingness to support the market. And bond yields have come down quite a bit. Capital markets are wide open, and we're not seeing many signs, basically virtually very few signs of any tightness in capital markets. And I think that's the biggest risk, in our opinion, of what could be the fallout of a trade war at this point, or an escalation, or the materiality in terms of impact.
If you ask yourself, what's my access like to capital markets this week? If you're an investment grade company, it's been pretty okay.
It's been very okay. And high yield as well. Loan markets back open. So companies themselves are financing themselves at a very attractive rate. And that's the mechanism. That's the transfer mechanism that goes from growth to company to impact.
I want to bring in Michael McKee, Bloomberg's international economics and policy correspondent. Mike, we do have an escalation. The tariffs are in, and we might get some more.
Yeah, and we do have some impact, and that is reflected in this Bloomberg News flash survey. We checked with economists who cover China overnight, and here's what they say. The tariffs that went into effect today should shave Chinese growth by about 0.3 percentage point. If the president follows through, does all $325 billion that haven't been tariffed so far, that will shave Chinese growth by 0.6%. What happens here in the United States? Well, that's what equity analysts are trying to figure out right now. I've got a couple of stocks that I want to show you that are impacted. I kind of did this through sectors. You look at the white line is John Deere. Of course, they make construction equipment. China's a big market. Agriculture, and we know what's happening in the agriculture sector here. You've got 3M. 25% of their business comes from China. You can see what the impact is. And, of course, what if China tariffs automobiles? Delphi, auto parts maker, way down. Here's the interesting one. Apple, if they do the $325 billion additional tariffs, that hits cell phones, and Apple customers are going to have to pay up to get new smartphones. What's the impact worldwide? Well, this is the global PMI that we were just talking about, JPM's global PMI, and then what's happened in the U.S. Manufacturing, yeah, Donald Trump, it started strong, but now it's started to roll over as people begin to worry about what happens to global demand given the tariffs. Now, we did just have some news on CPI, and Donald Trump just tweeted about it. Krishna was talking about the Fed cutting, maybe not, because look what's happened with the CPI numbers. They've gone up. If that pulls up the PCE that the Fed follows, you may not have an issue. And of course, if the tariffs keep going, we're going to see higher prices. The New York Fed, I just did a short segment, but the New York Fed did a study earlier this year that says the tariffs that Trump put in place last year have raised CPI by 0.3 percentage point, and that will probably continue and get worse if he increases more prices on goods coming in from overseas. So we could have more inflation because of the tariffs as well.
Hey, Mike, great to catch up with you as always. Off the back of that US CPI print, the Bloomberg dollar index at a low for the week. I want to talk about these automatic stabilizers, Kate, that some people have a lot of faith in. The belief that maybe the Federal Reserve, the next move is a rate cut. Yeah. And the idea of increased trade tension brings that forward. The belief that if we have more trade tension, China just increases stimulus. The belief that if the market falls too much, the president backs away. Do we have too much faith in these automatic stabilizers that some people think exist?
Well, let me just say our expectation is that the bar for the Fed to move either to raise rates or to cut rates is exceptionally high. It's even higher, frankly, to raise rates than it had been in, just a few months ago. But to cut rates, when the unemployment rate is so low, when the labor market is really strong, when we actually had a much better profits quarter and, a strong market, and I think George made this point in terms of capital markets being very functioning and healthy, we don't have to worry so much about financial conditions. It takes a big leap to get there. But I think the second point you brought up in terms of Chinese stimulus is super important here because the Chinese have been fine-tuning on fiscal stimulus. It has been largely effective year to date or really over the last 5 or 6 months. But they've also expressed a willingness to only stimulate in those specific sectors and areas where they actually need to give a little boost. This is not the same type of stimulus we've seen in the past.
Yep.
And so targeted and sort of prudent. And just like the Fed, I think they're going to be patient as they assess what the impact will be on their economy.